Mortgage-related ILS transactions are relatively new to the market. Like natural catastrophe ILS transactions, they are collateralized and used as a substitute for traditional reinsurance. Several of these transactions have been sponsored by private mortgage insurers. AM Best analysts Emmanuel Modu and Dr. Y. Tang examine how they evaluate mortgage-related ILS transactions.
So in today's webinar, we'll cover 4 basic agenda items. The first item will be on the basics of mortgage insurance. The second item will be related to the general transaction structure of mortgage insurance-linked securities, or MILS, as we call them. The third item will be AM Best rating approach to MILS. And the fourth item will be the reinsurance credit to private mortgage insurers that sponsor MILS. So mortgage insurance is a type of credit enhancement for mortgages with loan-to-value ratios of over 80%. And the loan-to-value ratio is a ratio of the loan balance to the market value of the home. And MI is most often used to credit enhance mortgages sold to Fannie Mae and Freddie Mac. An important factor in analyzing mortgage insurance is risk in force. And this is essentially the maximum exposure faced by mortgage insurers that cover losses in the pool of mortgages. Risk in force is a product of the MI coverage percentage and the unpaid principal balance of the mortgage. I'll now turn this presentation over to Y. Tang, who's going to talk about how we actually rate the MILS securities.
Thanks, Manny. So in this section, we will talk about the AM Best approach to rate the mortgage insurance-linked securities. As MILS are securities, we will assign long-term issue rating, or IR, to the notes. The IR ratings has 21-point scale from AAA to C. AAA is the highest credit, while C is the lowest one. In this slide, we show the idealized issue default matrix, which will be used later to determine the implied rating of the MILS. The methodology used to rate MILS is Best Insurance-Linked Securities in Structures methodology, or BILSM, while the criteria is evaluating mortgage insurance. The information that AM Best will be reviewed for the rating purpose is pretty standard in the liability structure transactions. So whoever interested in it can find the information in the BILSM methodologies. So I'm not going to get into detail here. Another item we want to emphasize is the quality control of the origination of mortgage loans. During the financial crisis in 2017, one of the reasons that mortgage did not perform well was the quality of the loan originated during that period was pretty poor. This concludes the section. I will hand over the presentation to Manny.
Thanks, Y. So while the rating of the MILS transactions are very important and interesting, we believe that what PMIs most care about is probably the amount of reinsurance credit they'll get for sponsoring these transactions. As many of you know, AM Best has a capital model called BACAR, which helps us evaluate balance sheet strength. The BACAR is made up of 2 main components, which is available capital and net required capital. So an MI that sponsors a MILS transaction will reduce their net required capital.
You can view this webinar in its entirety by logging on to ambest.com. For AM Best TV, I'm John Weber.